Northern Limited is John's entity. And your downloads, for those of you who are here live on the webinar with us, the downloads are in the chat box down below. So JR has just put the downloads in the chat box below. If you're joining us on one of the live stream platforms, be it Facebook, the Facebook group, LinkedIn, Periscope, wherever you're joining, JR is going to put a link in so you can download John's material and the slides of material to accompany today's session. Ask questions. Please do ask questions. John is here for the hour. He clearly is an expert in his field. Whatever questions you have, if you're on live with us, if you're on the Zoom call, in the chat box, but on any of the other platforms, into the comment box and ask the questions. Do ask questions during the session, and we leave some time at the end for John to go through. So we're kicking off here now at 2 o'clock. My intro is just coming to an end, the first 5 minutes. We're moving into our teaching space of 40 minutes, and then we will go to questions and answers and session close. And some of you, I can see from the attendee list, have become regular customers in the last 4 or 5 weeks since we launched this free series into the UK. And you'll know that I do ask questions. The reason why I ask questions is to showcase and highlight information that I believe is particularly relevant. And I want you to ask your questions as well. So, John, maybe if you could give us a brief overview of your background before you start, and tell people why they should listen. If they're here with us live, why should they stay with you for the hour? If they're watching the recording, what do you have to say that is valuable that accountants should hear?
Yeah, thanks, Des. I think the important message that I wanted to sort of convey is not just about, as you've touched on, the general markets for funding. It's generally the pitfalls that you can have if you approach funding in the wrong way. There's a hell of a technical aspect to debt and how each bank and how each funder will perceive and look at risk. And our job generally as an advisor is to pick that up within 5 or 10 minutes of a discussion, so that you identify the range of funders that you're going to go to fairly quickly. Now, clearly from a service perspective, that gives a significant advantage to anyone in an advisory capacity. What it does from an accountant's perspective is reduce a hell of a lot of time in trying to ascertain that potential outcome. So again, part of my history was obviously working with accountants as a banker, but also working within a firm as a head of corporate finance. And clearly, I would be able to cut the time spent, which is a bit difficult when you're looking at charging. But on the other hand, if you had a separate income stream that would start bringing in a return on the commission side of the revenues, then obviously it was quite powerful, because the clients, certainly the bigger and better ones, can understand sometimes when things aren't quite going to plan. So, to stop an accountant having to go out and have 6 different meetings with 6 banks who would go away, not necessarily give you their policy information. Our job is to have that policy information. So it's as simple as, if you need funding, go and ask a funding advisor. If you need tax advice and you need structural accounting advice, go and ask an accountant. But just be careful where the two mix. And I think it's just trying to explain that sort of coordinated approach and what the advantage can be. Not necessarily to find John Carling, but to find guys who think about it the way we do, because the world is becoming full of the larger, wider broker network. Some of them are not the right people to approach. And I'll explain, during the presentation, possibly some of those pitfalls and what we see regularly.
And I suppose the big thing for me, John, is Solutions Northern Limited. What you do is, you're not just coming from a banker's background, you're not coming from an accountant's background, you're coming from a banker who is actually part of an accounting firm. So you do have unique insights and a unique experience.
Yeah, not just that. I've been fortunate enough to run a sizable company. So when I left the accountancy firm, it was to go and work for a client of theirs as chief exec. So it was 12 million turnover, 550 staff. It was a very complex business with lots of moving parts. That's enabled us to develop our sort of executive support side of our business. So over the years, we've reorganized substantial UK franchise operations. I currently sit on the board of two companies totaling over 150 million turnover, very complex businesses, but it gives you an insight into how entrepreneurs work and the sort of the detail sometimes that maybe gets overlooked. And that's not just from a numbers side of things, it's from a people side of things. As a banker, you're taught to analyze risk in 10 to 12 different areas, from what a business has done in its past, where's it been, where's it think it's going, the industry it works in, the marketability, its route to markets. The nature of our mind is working across various sectors, and that's the nature of analyzing risk, which is very different approach to the accountancy training method of analyzing risk.
Okay, John, so in terms of having got a bit of a background, if you want to give us some more detail, or you want to get stuck into what topics you're looking at as part of your session.
Yeah, well, if I open up the presentation, because that'll feed into a few more points as we go forward. So if I follow what JR has told me to do. Hang about. I did warn JR that I'm not the most technical. So is that up on the screen now, Des?
No, I think you may go again. If you just go share screen.
Yeah, I have done that, but
and highlight the screen you want to share.
Yeah, let me just go backwards here. Right, go.
So if you highlight what you want and then press the share button, the blue share button.
Yeah, I think I've got it here. How's that?
Yeah, we have you now.
There we go.
Super. Those nervous moments, John, those nervous moments.
I say I have young people in the office that normally show me the technical side of things. So, okay, we've gone through that bit. So yeah, so in our team, this is really just to highlight the sort of level of experience we've got. So 20 years was the time at which I actually spent in the banking sector. At 32, I was one of the youngest commercial directors at Yorkshire Bank. By the time I was 36, I decided to move on, and that's when I joined the accountancy firm. In the team, we've got a young lad who's followed a similar experience. He's been through some of the mainstream banks. He also spent a little bit of time with Assets Capital, but he's just joined from Handelsbanken, who I'm sure a lot of you have come across. Dave, long-term business development director with Lloyds Bank. He was one of our main key contacts at Lloyds, and upon getting offer of retirement, actually approached us to come and work with us. The important little bit at the bottom there is our mortgage regulatory side, and I'll talk a bit more about the importance, I think, of having that offering alongside your main corporate banking and commercial banking options. That's really where we'll touch on the sort of the unregulated and regulated side of banking. But, we've been around 16 and a half years now. In that time, obviously we've gone across the 2008 divide. So the difference that we saw before then, which was manufacturing funding options, to the significant change in 2008, where, the market hasn't really changed since. I would like to think that our approach is very much whole of market. So, we are directly regulated with the FCA, but we source our own markets. We are constantly looking for new funding options. We receive notifications of new banks and new money that comes into the market, and immediately one of the team members is allocated to understand the policy directives of that lender in some detail. We have a Bible that detail is then effectively dropped into, which tries to drive the streams of lending out, which again I'll touch on later on. some of this is seen as involved in pre-commencement delivery of banks and policies. So Atom Bank was a new to bank provider about 4 or 5 years ago. We were very much involved in the delivery of their commercial option beforehand. So discussing the sort of policy variations that they might want to bring to market. We were one of the first brokers on their platform, as well as the market came out. I will say now that I really don't like the word broker. I don't like, as a banker, I was never too chuffed about the way the brokers dealt with me. My feeling of a broker is somebody that was more focused on commission than he was the client. So we tend to use the advisory tag, and people know us, certainly in our region, for being bank managers, with the access to various different forms of income. So our transactions are relationship driven. We look after our clients every single time they go back for funding. We will deal with transaction queries, processing queries within any delivery of a transaction as it's going through, as though we were part of the banking team. So we are often the person that is liaising with the accountant, the solicitor, the valuer, whatever needs to be done to get that deal complete. Because as you'll all see, the general point that I get paid is on completion or after completion. Up until completion, we are totally at risk. We don't take fees up front. We were fortunate that Lloyds Bank had their first and ever broker awards event, and we won the Trading Broker of the Year. So it's just a little bit of a reference, I suppose, for. We were well thought of in 2018. That's what I can say.
As to where you are, exactly.
Yeah, I haven't had any since. So yeah, the three topics, and the reason of the key message here is trying to understand the detail that represents itself behind the decision of where you go for funding. It's, as a banker, you're trained to be the friend of as many professionals and introducers as you can be. And you've got a bag of tools that you can deal with that are set by that bank. What you've got to understand as an advisor is, just because you like a guy doesn't necessarily mean he's the right one to deliver. And the route I had into accountancy was to work with the senior partner of the firm I went to work for. And he would ring me on every single funding query he had. What I'd got to know is who was the best person to do things, and I wouldn't always take the deal if I knew I was a long way off. What I could do, though, was tell him where to go and effect that introduction. So I was an unusual entrepreneurial banker that knew my competitors exceptionally well, and it allowed me to win the business I knew I could win, and then farm the business that I knew I probably couldn't, but I'd get to know that person for the point at which I could walk back through that door at some point in the future. And that's what's effectively made us, I guess, so successful today. So the difference between regulated and unregulated lending, I don't know whether people realize, but not every broker that you'll come across is actually directly authorized or regulated through the FCA. The reason a lot of them are is because you can't get paid by a lot of banks unless you are. And it's what they are termed as permissions. So you have the permissions through your FCA regulation to get paid directly from the bank as part of their fee. The only thing about the regulation, though, is that it really only takes account of individuals. So if you're lending to an individual, a sole trader, that is the only debt that you report to the FCA. You don't report anything to do with limited company lending. And obviously, the majority of what we write is limited company. So
that's really interesting. Whoa, there's feedback there. But what you're saying is regulated entities, they are regulated, but they're only regulated in relation to their individual lending. They may not necessarily, there is no regulation or safeguards around lending to companies.
Limited companies at all, no. Now, it's that it should change, Des, and I think it will. But it's just highlighting the risk here of advice and what's behind the advice. For me, there's absolutely no difference between the director of a limited company and the guy himself if I'm advising him on two different sides of a transaction. but all I have to report is if I do a transaction for him personally and not for the company. Now, you know, this is one of the biggest keys that you've got when it comes to the mortgage advisory regulations. There's a lot more compliance implications when you're dealing with people's houses, and then obviously investment properties. But generally, there's a higher weight of those sort of transactions are for the individual, albeit since the tax changes, we've obviously seen a lot more buy-to-let, limited company buy-to-let options, that sort of thing, but that can be delivered in that regulated mortgage space, not the commercial lending space. Now, there are very few commercial brokers, advisors that have both sides. So what you've got is a lot of guys that concentrate purely on that commercial, and they'll use commercial lending products only, not a mix of them both. And the reason for that in a lot of cases is because the earnings potential through the mortgage advisory side is a lot less and the regulation is a lot higher. Now, ever since I started, we've always had a regulated partner alongside of us. There have been occasions we've delivered it in-house. There's occasions, the current occasion is my team highlighted on slide 1, is run and operated by a guy called Mike Smith, who was head of private in my regional team at Yorkshire Bank when I was there. So he's been a private lender for the majority of his working life, and there isn't a lot he doesn't know. He's been self-employed now for 12 years in the mortgage market. Before that was a regional director for NatWest after he left Yorkshire. So highly experienced guy, got a young team of sort of regulated individuals below him. But essentially what that allows us to do is mix and match our funding. So, you know, if you think about the methods of debt service calculations that you've got in banking, you have much more sensitivity. So capital and interest calculations, the banks aren't really interested in interest-only lending anymore. If you look at the regulatory approach, you've got a lot more simpler debt service cover. It's generally on an interest-only basis. They are generally cheaper to set up. So if we are taking a portfolio of an individual who's got commercial assets and residential assets within his portfolio, I can guarantee you there's a cheaper method to split the residential stuff and put that with the building society driven lending, and then look at the commercial elements and put that with the bank side of lending. One example of this we had recently was when one of my new team joined in January, we took an example of bringing up one of the commercial lenders from Aldermore Bank. He's a bit of a pal of ours. We've known him a long time. Strangely enough, never written any business with him. And this guy does 50 million of debt a year in the broker space. And the example was not just to say hello and have a cup of coffee, but it was to across a new member of the team, the importance of and the benefit to the customers of using the two products, and why that generally means that we don't do any business with Aldermore Bank. Because when you look at them in comparison, they'll do the whole lot, but it's a lot dearer. It's a lot more stressed in terms of the repayment models. And ultimately, you know, when you look at a like-for-like comparison, yes, there's a lot more work for us to do because we'll have independent transactions to do based on each individual residential member of the portfolio. But essentially, the net result to the client is they get more money and they get it at a cheaper price and a lot more flexibility.
And that's that's kind of important in the whole process.
It's massive. And like I said, if you literally just go on a website for most brokers, they will not have that part of their parcel, but they won't explain that they don't, because they don't have to. They're not regulated to. If they don't offer it, they're not going to say, just letting you know, guys, we don't have a mortgage advisor in here. They're going to say, listen, if you know, on the suite of transactions I can give you, this is what I can give you. And it would be an Aldermore all in one place, nice and simple, pass it off, fill the forms out, send me the commission guys when I'm done. Instead of, actually, hang on a minute, what's the right transaction for the client? And this is just a bit of a heads up tool to say, if you're looking at the right product, the right advisor, understand the difference between the unregulated space and the regulated space. If it's residential, you may want to be talking to a mortgage broker, not a commercial mortgage broker. Okay.
I see there's a question, there's a hand up question here from, oh, it's gone. If anybody has questions, folks, if you're here live on the webinar with us, if you put your questions into the chat box below, we'll be able to answer your questions. And if they come in on the chat box below, we will see them. If you're watching from anywhere else, and if you're on any of the other platforms, please just put the question into the comment box below, and Jonathan will transfer them through to us here. And yes, we are asked the question again this week, can we share this with colleagues and co-workers? If you share the link to colleagues and co-workers, even if they click on the link now, they'll be able to join John's session. So John, pre-COVID, there's been significant amounts of change in the lending market. Everybody's kind of a financier now. Everybody's a bank manager.
Yeah. Well, yeah, and it's as simple as that. Obviously, I mean, again, if you're lucky enough to be able to sit in amongst the source of business, the only thing you've got to understand is how do you get paid, because without the permissions, without the FCA regulation, you can't secure the income stream from part of the bank's fees, which would be crazy to try and do. I've seen a few do it, but to get the permissions is surprisingly not that difficult. You've got to show a level of expertise, but to be honest, there's not necessarily a hell of a lot of checks and balances in that process. So, I've seen people who, and I know guys who run large broker operations that are ex-bouncers on doors. They've been mortgage advisors at some point, but they're now in the commercial lending stream, and they've got no actual clue about risk management, about analysis of risk. I mean, any banker that makes it to a senior level has gone through more courses on cash management and understanding accounts and the movement with your source and application of funds, and how a balance sheet works, and understanding terms of trade, and understanding all those key KPIs. You start picking up a feel, but it's not just about the numbers. I mean, we touched on it earlier, Des. The numbers tell you one thing. But if an accountant is wanting to present a set of numbers that benefit a client in terms of tax, the bank has got to see behind that and understand that perception of risk. You've also got, situations where debt can be very much forecast driven. So if it's forecast driven, you've got to get behind the forecasts. How are they achieved? What are the downsides if they're not? What I thought was important with this particular slide was just to give people a flavor of, very simple forms of funding, but the ones that we all see and know on a day-by-day basis. So we allocate them into various sections. So trading debt, so any business that effectively trades, has employees, it transacts purchases and sales. And some of the key areas there are defined because the banks concentrate and have preferences in certain sections. So you've got the agricultural, manufacturing, leisure, care, all that sort of stuff. Investment debt, yeah, well, very much, that is, I bought a property, there's a tenant in there, whether that's resi or commercial, and ultimately, it is what it is. But we've seen significant changes in that marketplace since 2008, and they're not going away. The deals the banks got themselves into before 2008, they'll never fall into that trap again. The next one, the short-term lending marketplace, what we would call the bridging marketplace. So you're putting short-term solutions in to secure gap funding between one transaction and another. We could spend an hour in there because that's where the sexy money is. That's where the return is, but that's where the major risk is. So you get people into things there and you can't get them out. You've got some serious problems. But that's huge. Even during COVID, we must have seen 4 more new bridging market lenders come into that space. So they'll have been coming for a while. They've been getting the permissions and the licenses and whatever else, but they're all launching still because they know that that's massive and that's never going to go away. Obviously, the invoice finance, stock finance, asset finance, trade finance, what we call the ABL market, the asset-based lending products. They'll be the ones that get us out of, they'll see the growth as we get out of the furlough issues and businesses need funding to trade on. I think a lot of them are sitting back and waiting to see if the floodgates open. But that's probably been one of the fastest form of funding market growths now for probably the last 20 years. And it's because the banks don't like overdrafts. You know, if you're seeking an overdraft, we've got a client at the minute who's a part of a global hydraulics business. They've not got any facilities. They've tried to approach their bank for £1 million overdraft during the COVID exercise, and the bank said 3 to 4 months before we can look at it. So the call that I got was very much, look, guys, you know, I can understand why the banks don't want to look at it just yet. You've got the option of invoice finance. That's probably the way that everyone's going to push you, because nobody really likes providing you with £1 million overdraft that you might not use much in a month. You know, it's debt that's out for no return. So let's understand how banks select debt. Supplier payments funding, whether people have come across that before, but it's an additional exercise form of funding that links to your purchases. So it's like a reverse factoring facility. It's also provided through some of the high street banks under their loans against import trade finance schemes. Development funding, obviously, you know, was significantly pulled post 2008, has found its way back to being quite a popular area of funding today. Be interesting to see what COVID does to that sector. I'll tell you a bit more later on about what it's done right now, but that's one that we could see again a bit of a stall on long term, depending on what happens to the mortgage market. Funnily enough, then we've got the unsecured, what we call unsecured. It's generally always secured by way of some form of guarantee, but this shorter term, small term overdrafts, effectively they are, you know, which are very expensive. Generally, there's a lot of peer-to-peer, so we've got your funding circles, your IWOCers that are in this space. Again, a real cautionary approach. Just to let you know, from an advisor perspective, we will not process a funding circle application. We will not process an IWOCer application. Some of the issues that we see behind those businesses really concern me as an advisor. I would much rather the client, if we think that's the only answer, they go direct and negotiate as best a deal as they can, because these products are full of commission for introducers, and you're talking 4 to 6%. It's disgraceful.
All these commission structures just adding on the cost for the end user.
They're all in the costs, yeah. And if you look at the setup cost, I think even in the CBILS product for Funding Circle, it's a 4% setup fee, and I think nearly all that 4% is paid to the introducer. The interest rate sits at about 7%. I mean, it's cheap for Funding Circle because it's partly government backed. But when you look at the normal day, you know, you can talk to these lenders and they'll ask you, what is your fee? And they can put 4%, 5%, 6%, right? Okay. And then they'll accommodate their costs over and above. So before you know it, you've got this blended facility, you've got nowhere to go, and you've got the broker introducer taking a massive amount of money on it. And he doesn't necessarily openly disclose what he's took. So
there's a very practical question in here, John, from Mahmood, and it's, how would one arrange for a sinking fund facility for a residential tower, 5 million sterling for changing the windows?
There is a fit out debt facility. So if you've got, I mean, again, it's all about serviceability of that tower. How does the income come in? Who owns it? What's the structure of that? But there are, I mean, we've got a couple of deals that we've been looking at recently where they are funding the fit out of office blocks. So we've got a big energy company that sources the energy transactions. They've bought a nice big place not far away from us. They were looking at a £2 million contract to literally, you know, refurb this place. There are specialist funding models that will break that deal down and allow the parts of it to be funded. So literally, if I can pass on my details to Mahmood afterwards, and if he gives me a bit more detail, we can certainly have a look at that one. There's probably only about 3 decent lenders in that market, but what you find is you actually transact, or I will transact, with an intermediary that effectively ring fences the transaction and then sources the individual products for us. It's very, very specialist. It's a form of asset finance essentially, but it's very difficult to go and repossess a window. So, if something goes wrong, it is high risk, and therefore very, very limited appetite. Certainly that appetite has been impacted by COVID. So we'll have to have a look and see whether that could be, is it available now? Certainly wasn't available in the last 2 months when we've been looking at a couple of cases. But it is something we could explore for you. In a lot of cases, there are options. It's just looking at the cost of those options. Would it be best for the owner of that tower to secure that work by way of a refinance or an extension on his existing funding? Well, I suspect it would be, because the repayment profile of the windows is going to be a lot shorter than the repayment profile against the asset. But that's just an analysis discussion. What's his funding position now? Could he do it? Can't he do it? If he can't, let's explain why.
There's another question in here from Mary in LinkedIn. Is talking about platforms here, and she's mentioning Crowdcube. Is that another one of the platforms that you will come across?
That'll be, one of the many. Yes, that'll be another probably peer-to-peer option. Honestly, the list is endless. The analysis
growing.
Say that again, Des.
The list is endless and growing, John.
Oh, it is growing. Yeah, it's significant. And what is worrying a bit is that NACFB, the National Association of Commercial Finance Brokers, are identifying that they see a growth in peer-to-peer availability as we come out of COVID. So, I'd be a wee bit concerned. The problem you've got with any peer-to-peer is you don't know it's there until such time as you ask for the money, because they haven't raised it in most cases, unless they use their own money. So if you use the assets capital type model, the funding circle type model, you have to sell the debt. There are products that have to attract the investment to be able to pass it on. Now, if you're in a legal chain in readiness for completion, how do you know the money's there? If you get to the end and somebody's, well, actually, sorry, I haven't got it yet. If anyone's ever dealt with people like Lancashire Mortgage Corporation and now the Together organisation, Together will issue you, any broker can issue you terms on behalf of Together. They've got them online, so they can say to you, oh yeah, that's a doable deal, no problem, issue you the terms. Before you know it, you paid a valuation fee, you're into legals, you've got your costs. The decision, the actual final decision on drawdown is only made on the day of drawdown. So it goes in front of the board. The board have a look at all the paperwork and they say, oh yeah, no problem. Now, the reason we found that out is we were dealing with a client right on the day of the Brexit decision. So we were due to draw down the day after Brexit, and it went in front of, I'll go back a week. So a week before we were due to draw down, it went in front of the board. The board had a look at the case. They said, you know what, we're going to give you £70,000 less. So we said, well, hang on a minute. We've been in this legal process for at least 3 months. Why are we just finding that out now? Well, this is the way we work. This decision is made today. So within the week, we managed to find a bridging solution for the shortfall. We went to complete the next week, and it was the day of the Brexit decision. At which point, Together said, we are not releasing any money until all our valuations have been reviewed again. Now, if we hadn't have had the relationship with the valuer and the strength of character, I guess, to say, look, hang on a minute. I got on to the valuer. I said, 73% of the people in that area voted to come out. You get on the phone now to that director and tell him that valuation's still fine. And he did. And we got paid out that day. And I've never done a deal with them since. Now, don't get me wrong. You have to still give the client the option as you go through it. but you never forget the lessons you learn as you go through this process. And the client needs to understand it. If we have no choice and we've got to take that risk, then that's fine. We'll take that risk, and that's the client option to take that risk. But we're doing the wrong thing if we don't identify that risk to the client. And they're a much bigger organization now, but there's another one in COVID who have pulled their products. They'll only deal with existing customers. So they shut the door on the external world altogether. And
this feeds into what we discussed. I think is your next point, John, in terms of the considerations behind choice and choice of lender.
Yeah. I mean, one thing that we do. So if we sit in front of a client, and that client may be somebody in the leisure sector, so a pub, a restaurant, a hotel, let's say a nursery operator, you immediately know which bank will treat that risk in a very different way to all the other banks in the high street. And it's not about the debt servicing, it's actually about the way they look at the valuation. So you've got these key areas that you've got to think about whenever you're doing your analysis. One is, does it stack up? Can I prove affordability? What's the sector preferences like? How is that treatment of that valuation actually undertaken? So what will be the instruction that comes out from the lender? Because some of them will take very much into account the vacant possession value, and you'll have a policy that you're not aware of that allows exposure up to a percentage of the vacant possession value and a percentage of the open market. Some of the banks remove that vacant possession value altogether. So you've got every chance, if you can look at the trading value of that business, is getting it through. And it's that level of detail that isn't generally explained to you, because the bank want to try every opportunity they can to secure that funding deal. That's their job. It's not their job to tell you what the competitor market does. That's our job. That's what we've got to do. So we can look at things like nursery operators. We did a transaction last year for a large nursery operator, and we funded that to somewhere in the region of 82% loan to value. No other bank could have got it to that level than the bank we actually dealt with. Now, that's just understanding the availability of the policy, but I didn't have to go around 6 banks to make that decision. I knew that within 5 minutes of sitting with the client when I met them. So
from a technology perspective, and obviously I'm very much pro technology, John. I'm all about, embracing technology, because, and I think the accounting profession has to be about embracing technology.
Yeah.
But do you know some of those service providers where they're essentially aggregators of quotes and stuff? Does that give you the coverage? Like when you talk about that nursery, that was obviously a needle in a haystack to identify the most suitable lender.
It would be if you didn't do it every day. The fact that you do it every day, and we are constantly talking to the banks about updating appetite and policy, and they do change, and the banks aren't necessarily quick to tell you that they've changed appetite. That's just about communication. But again, that's the time that you spend doing what we do to make sure that we're talking to them all the time. Now, again, when you look at, all these different crowdfunders and different bridges, that is a different exercise. Generally speaking, when you look at a bridging transaction, you very much go out to quite a number, because the variations can change on a whim. And, that takes a lot of time. Generally, though, your fee levels are slightly higher in the bridging market. The share of the fee level is at the top end of what you would normally get. 1%, it's not important, but the bridger knows to find him, you've gone through a fair bit of work and he wants paying well, and you ought to get paid well. But then there are other things around bridging that you've got to get your head around. And that is, what are the exit plans? So is this a closed bridge? Have I got 6 months, 12 months, 18 months, and then the wheels are pulled? Or have I got a relationship with that bridger where I know that if my client hasn't done what he thinks he's going to do, I've got the ability to extend and I'm not putting him at risk? There are bridges out there that will do open-ended bridges. Again, it's a huge needle in a haystack, and that is the high street banks. There's not that many of them. You may choose across any sort of 7 options. They're easier to keep a track on. That wider market isn't. But again, when you look at understanding debt service cover, and again, this is more linked to the high street and the more mainstream. If you look at investment-led deals, what a lot of people don't understand is the difference in gross and net debt service calculation. So back in the day, everything worked off gross rent. Today, it doesn't. It works off net rent. So what you've got to understand is what is looked at in terms of the analysis of what comes off that gross rent to actually then work out your debt service cover. And that can be, the variances in that are huge across the sector. Lloyds Bank, for example, can go from anywhere from 15% to 30%. It just depends what sector you're in. It also depends on what your accounts say. So when you're looking at, producing your accounts for your client, there's always got to be an eye on what are your plans for borrowing over the next 12 months or 2 years? What have you got coming up? Because if we're trying to mitigate tax on one side, but then I can't prove debt servicing on another, you're going to struggle with your recovery. You're going to struggle with arranging your debt. You're going to put yourself in a market where, it could cost you an awful lot more because you've had to come down the level of and quality of the funder that you've got. So sometimes that look ahead, that planning element, has got to cover debt just simply what you're going to report. So we've got a 10 million pound portfolio that we're looking at the minute. It's 300 properties, and ultimately we're trying to squeeze it into a debt that operates on a policy of 10% deduction for operating costs. The accounts show 34%. So as much as you're benchmarking the policy, will the policy fit? Will the policy fit? The truth, when you look at it, and you're sitting with a client saying, "Look, we're going to put this in. We're going to try and get it to squeeze into 10%," but you're actually showing 34. So you better tell me a bit of a story of what's going to change in the next 12 months. We're ahead of the game. So I've already got the story boxed off when I'm going into the bank saying, "Look, you'll see this. But going forward, this is what's going to happen," and look at the management of the bank account and all that sort of stuff. So, this is the complexity that's in the analysis, that if you take your client's deal to the market, once that deal is in front of the bank, you can't take that information back away and say, "Oh, excuse me, made a mistake, give me it back." You get that presentation opportunity and you've got to make sure you get it right.
So
There's always... Sorry,
can you give us some practical examples, John, maybe now or in a couple of minutes, of where things go wrong and where things...
Yeah, there's a slide on that, actually. I'll come to that. I've got three examples for you. Just a bit of housekeeping here for the structure of deals post-approval. So you've got to look at commitment terms. How long is that commitment for? Post-2008, the majority of commitments are 5 years. Is that 5 years, harsh 5 years? Is it a bullet repayment? Or is it one of the banks that are a wee bit more flexible and you're a bit more confident about the cost of rolling that back over again? We know that in most offer letters, you will have a 3-year requirement for valuations. There are some banks don't bother. As long as you're meeting those payments, they'll get to the 5 years, they'll get to possibly another lend before they'll even consider having to do that. There are some banks that will insist regulatory on doing that 3-year valuation right on the button, and it's expensive. So you've got to think about these things in advance when you're looking at your choice. Clearly, pricing, there are massive variations across every sector in terms of price and the structure of the price. We do an awful lot of analysis for the clients on analysing the impact of margin over fees, because it depends how long you're in a debt as to whether the margin actually makes much of a difference. If the sweep fees have ins and outs, you've got to look at the impact of the ins and outs rather than the margin. But we often drop them into a little cash flow forecast to say, right, compare the different lender, the different costs. Boom, there they are. Development, when you're into development debt, there are 2 key parameters, and this is there just to, again, give you a flavour of the technical side of lending. So development debt comes with 2 key tests: loan to cost, loan to gross development value, which is effectively the selling prices. The impact there is you could have bought a farm many years ago for £100,000. You've subsequently got planning on it and it's worth £3 million. You go to the bank, this is easy, I own it outright. It isn't easy, because they're looking at loan to cost. How much have you got skin in the game? So again, it's structures. There are some funders that will accommodate it, some that won't. Don't spend hours and hours and hours trying to find the right one. And then, the general lending and drawdown process, there are some lenders, both in the regulatory and the commercial world, that are just horrendous to deal with. Very lengthy processes, very arduous to get through. If you want a deal doing in weeks, some of them fit, some of them don't. So it's more about experience there. This is the slide I think you were looking at, Des, in terms of a couple of examples. So, and these are all actually fairly recent, but example one was it's currently a bit of a legal case. We're looking at a former Premier League footballer, and he played for one of the teams up in our neck of the woods, and we got asked to have a look at what he'd been put into on some investment lending, and it's more residential based. He'd been actually put into it, a mix of his agent and his agent's funding advisor. The funding advisor had actually secured some short-term facilities with a funder that he was associated with. So essentially what he's done is he's gone to a private fund on a private deal at a private price with a load of setup costs, telling him that, look, this is the only way we could do it. He also used a peer-to-peer funder. It was a £1.5 million facility, something like 13% with 6% setup fees. So that meant he probably took 3% over their fees. So they'll have charged 3, he's took 3, and he's walked him into a 13% margin, all in lending fee. And that one was interest only, and he had a 3-year transaction. Now, the guy is non-UK resident. He's non-dom, he doesn't live here. His family do, but he's based abroad. So you've got implications of how do you get him to fit into the UK funding markets. And typically when we get the sort of analysis as to what are our initial short-term problems here, well, problems were you were coming up to expiry of all these facilities, which is at a point where you can attract some significant costs. So we need to be careful of that. But ultimately, hang on a minute, what solutions are out there that we could look at in terms of moving him on? And we had to go through a bit of an assessment. Obviously, he's lost a hell of a lot of trust with advisors around him. His solicitor, who was looking at the litigation case against these advisors, was obviously keen to make sure it wasn't out the frying pan into the fire. So getting the information from his team took a little while. But as soon as we actually gathered it, bear in mind it took about 2 or 3 calls to get it, there was one thing that just stuck out with me straight away, and that was his day-to-day bankers in the UK, predominantly the principal funders of most FA members. And they are part of a major bank, and they don't have credit policies that can pretty much do what they want to do for the right client. And why on earth the football agents and the advisors didn't know that, bearing in mind that's the job, is beyond me. But we basically, as soon as I saw the bank statements, right, stop the bus. Everything else we've been thinking about, just forget it. Straight on the phone to the bank. We got him and secured him a deal at 1.8% over base rate and a 0.35% setup fee. And we just agreed to charge him a fee over and above, because that particular funder doesn't recognise introducers, which is probably why the introducer didn't go there. And that's what you're up at. Now, the saving to him is absolutely massive.
Astronomical, down from 13% over base.
And that's on 1.5 million quid, and ultimately the structure of the transaction works for him. He was given 4 properties back in the whole process, which he can sell, he can do whatever he wants. He can raise debt on them with us again if he wants to. I think the plan is he's only a couple of years off probably packing in football from where he's playing now. So, the view is, look, let's get those sold. Let's get you another property in the UK. the investment property that he has is currently occupied by one of the best players in the Premier League in Cheshire. So, significant asset. And that was just one of the easiest deals I've seen in years. And it was staring them in the face. And it was just a clear example to leverage income from somebody that knew probably just wasn't aware, wasn't looking at anything. It worries me about, again, the general sort of experience that people in that situation go through. But I think the one before, the next one, the incorrect funding mix. I mean, I touched on the Aldermore bit earlier on. We've got numbers and numbers and numbers of examples where we may use an Atom Bank commercial product sitting alongside a buy-to-let, limited company buy-to-let, and the savings over the Aldermore type structure are absolutely significant over the 5-year period that you're going to be doing the commercial element. Obviously, the buy-to-lets, well, you take your 2-year fix, your 5-year fix, or whatever you want to take, but there's no end to those. That's a commitment for 20 odd years, interest only. You've got a lot more flexibility in age. Whole host of reasons why, you would want to look at that sort of structure. The last one was probably going back to the argument over the IWOCers and the funding circles. So we got introduced to a training company by HSBC Bank, and the guy at HSBC used to bank this business when he was at NatWest, and they were very much involved in the sort of what they call the ESFA training. So you effectively are given a budget, you apply that budget. Sometimes you will get a clawback against that budget if the number of trainers haven't gone through, whatever, but it's a very difficult income stream to fund. You can't normally invoice finance it because there's no absolute guarantee the amount you claim is ever correct, because there could be a clawback. So we knew it was going to be a bit of an awkward one. But effectively what had happened is the business had plugged its funding gaps just by more debt. So all you had was this increased debt. So you'd gone from some of the cheaper money to Fleximise money to IWOCer money, and IWOCer was 3% a month. Another broker had put him into, after 3 months, had told him 2 weeks before completion, having promised him the money, that he got him it, and it was secured by a second charge on his house. This guy's 67-year-old, and he had to tell his wife that he had to take it, otherwise the business was bust. And he had something like a 2-year bridge getting paid at 2% a month. So you imagine how fast he's having to run to try and keep up with these things. So we're looking at it and thinking, this is a basket case, this. How the hell do we get this structured right? And I was sitting thinking about a deal that didn't go ahead. And I remember looking at this deal and looking at the funder that was behind it and thinking, I've seen them on some data before. Let me just go back and have another look and see whether this has got legs. What do they actually do? What variations do they do? Because again, when you get a flyer about a particular type of debt, it doesn't necessarily mean they'll tell you about everything they've ever done. Before we did it, we did a lot of analysis on the because it's ESFA, and we've been through an ESFA business before, actually with the FRP guys, who I think have done some presentations for you. We were looking at the nature of their contractual records and how good they were and accurate they were in what they actually requested from ESFA and what they actually received. And they were within a band of about 95% tolerance. So it showed that they weren't overclaiming and getting big adjustments, so like big credit notes, which comes with the invoice finance world. So going to this particular funder, we were able to present a very strong management case and a very strong financial case for effectively a created form of invoice finance. So, we know we can't secure against that invoicing properly. We know there's no collect out against it, but there is an income stream that is very consistent that comes from it, and it's within a 95% tolerance. So even if you fund it at where we wanted it to be, which was 65% of the debt ledger, it allowed us to clear out all this unsecured debt, because we could pull about £650,000 out of it. And effectively, the funder had never done it before, doesn't want us to advertise it because they couldn't necessarily do it for everybody. But they drew that down and paid out literally 2 weeks ago. When we told the director, and I've never heard a guy cry so quickly in his life, because effectively that was his house out of the line. That was the failure of the business that, you know, could have been any time. It was just facing issues, you know. And essentially that was just, again, it was having a gut feel that we could work off. We'd seen something similar, go and explore it. This product didn't exist, but because of the presentation of what we could give them, because the strength of the financial information was absolutely bob on, you know, they were willing to take that risk. And that's that just broadness of the market. You know, I can say we've probably, you know, pulled that off about 10 times in 16 years, where we've been able to create. A lot of that was before 2008. Creating after it's been very, very difficult. But to do it with a company that was so well managed, but just in such a shit state with, you know, the finance mess, it was great to see. So,
I'm conscious of the time here, John. We're coming into the last couple of minutes. So in terms of looking at life after COVID, in terms of pulling things together, what are your sort of final observations? What are your final comments?
Very quickly, during COVID, we've seen a major change, major impact on policies, banks coming in and out of deals again. So the big message to that is learn the lessons of it. Be careful about who you choose as a funder, because it's no good to you if they're pulling out of the market when you need them. Basically, for the accountants, CBILS was always the horrible product to bring it out on. It's based on EFG, SFLG. That's very difficult for the banks to analyze because they've got to look at that 20% as though it's 100% of the risk. So a lot of things we've seen during COVID where there's no surprise there. The life after, the biggest concern we've got is the effect that could come on the mortgage market, because there's a real concern over anyone that's took payment holidays, any self-employed people that have took bounce back loans, and how those accounts are going to need to be adjusted to accommodate the timing of the repayments of those once they're due. So there are banks now considering their development funding policies on the back of the future impact of COVID. So we are looking at a lot of the guys who jumped into holidays very early on and say, look, be careful, because, you know, if you didn't need it, get it paid back. If you need the bounce back loan and it's looking like you've got through it, get it paid back. Get these things off your credit record, because as much as the government have said, you know, don't let it affect your payment history, I think the chief executive of Nationwide Building Society said, well, we're going to look at it. And I think there'll be a lot more that do, because if they think that you're the type that will run for cover, that they are, you know, they've got an eye on you and it's going to affect you, because it's just the way bankers think. There's an element of risk, there's an element of caution there. You know, what part do you guys play? The presentation of financial accounts is fundamental to every transaction we do, even the bridging ones that want to know where affordability is coming from. But if you're going to partner with someone like me, just look for the guy with the history, look for the guy with the personal risk, the one that's got the grey hairs, he's been around, he's been a banker, he's working in a network, he's perhaps working in an area that's important to him. We don't take fees up front. We don't take add-on fees. So the only time we have to add is a bit like the football. If we can't get paid within the deal, then we've got to talk about some funding. That one was very different. 9 times out of 10, the bank charges a figure, whether it's 1%, 1.5%, 2%, whatever it is, the introducer can get a fair slice of that, half of it generally. Well, you know, if you're doing the right sort of level of transactions for the right reasons, you should be able to live off that and make a very good business out of it. And we have. We've never charged upfront. We don't charge that pre-assessment. A lot of guys do. Guess what? They know they can't do the deal, but they'll take £1,000 up front and then sit it on the desk and then come back to you after 3 months and say, I can't do it. So be careful. Pick the right guys. We very much geographically located. We like to work within a sector. As part of this approach, if there's anyone that wants to talk to us, our minimum deal size is £100,000. Below that, it's not really anything we can get paid out of. So we'll give a bit of advice, point you in the right direction, but leave you to it, because generally the process of these things takes as much time to do a £100,000 deal as it does to do a £5 million deal. I need the same information. But if in doubt, give us a shout. You know, we're here. You can find us on a very simple website that we have out. About 60% of our business is introduced by the banks. We get very little from the accountancy network. Something I was talking about Des earlier. The accountants we deal with tend to be the bigger and corporate finance type guys.
Why do you think that is, John, that you don't get work from accountants? Because just to make there's a comment in here. This man knows his stuff, so let him run on for a few minutes. Now, obviously, we need to wrap up our live event. We need to keep.
I get it. Yeah.
Keep it. But I'm intrigued by this because it sounds to me, having listened to you, and some of our attendees agree that you do know your stuff. It would be very logical for me if I was an accountant and I have a client, and this isn't my forte, to work with somebody like you. It strikes me as really being strange. Why do you think accountants don't pass more work to somebody like you?
I mean, look, yeah, well, I worked for a firm for 12 months, and the senior partner in that firm was a bloody good fee generator, and he had no fear at all. And I'm not don't want to criticize your audience, but he was quite happy for me to sit in a room and give banking advice at the same point he was on the clock and charging for sitting there listening to me talk. So I've always had a bit of a concern that by doing something faster, I'm potentially taking income from the accountant, because he wants to have the relationship with the bank. He wants to have the time charged. Now, this is where the secondary income stream comes in. If you're a successful accountant and you're successful because you give the right advice, you do the right things, that's what's worked for me. So, I've never changed from the method and the mindset that I've got, because I know it works for me. So I don't want to charge up front. I don't want to do these things that I know other people do. If I've got the ability to do what I do as an accountant, and that is concentrate on my tax work, my accounts work, all the information that I need to provide, and I've got a guy there that can help me with the funding, and by the way, he'll give me a trail of the deals that I've written for him, then that's generally available, and that level of trail is dependent on the type of person you might find. We pay anywhere between 10 and 30% away, sometimes 50% if the deal goes really quickly and it's sizable. But ultimately, the key for me is, gain the benefit of having this expertise on board. Every client that we discussed one, we were on a Zooms meeting for a big firm last week. The discussion was very much, look, you can't do what you want to do, and this is why you can't do it. This is what I would do if I were you, is actually stay put, stay where you are. The accountant on the call was on the clock, and I don't charge anything. So I'm just got some goodwill out of that. The client said at the end of that meeting, absolutely fantastic. I know exactly where I am now. Please keep an eye on the market for if you think anything crops up that I think I could use. Other than that, if I ever need you, I know where you are. That's how we get our referrals. So they come back to us, essentially there's a trust element that if your client comes back to me, well, guess what? I'll be giving you a shout and say, look, by the way, I've written another client for, deal for Bill, and I'm sending you a bit of money. And that's the trust bit. So, part of my team, I have guys who specialize in certain sectors that don't work for me. They have done for 16 years, but got their own business. They'll go and see my clients. The client will tell me, I've had Mark over, he's just done me another car and whatever. And then next thing I know, there's a couple £100 arrives in my bank account. I can't be everywhere. And it's the same for you guys. Find the right people. They're on your patch. There's more retired bank managers out there doing this now than there ever were when I first started. There was enough of us then. If you need something in the short term and it's of a decent size, please get in touch with us. If it's the northeast of England, this is where we are. If it's Yorkshire in the northeast, we'll do that. But generally what I struggle to do is anything on, outside of area, because I don't know it. I'm not as confident. I'll help you. I'll point you in the right direction, but find the guys on the doorstep. That's the way it works.
Okay, well, John, there's a couple of questions in here about where do people find you.
Yep.
So John's website is www.solutionsnorthern.co.uk. www.solutionsnorthern.co.uk. John's email address is a difficult one to remember. It's john@solutionsnorthern.co.uk. I have put up in the chat box here John's landline number, but with the email and the website address, you should be able to find John.
Yeah, best off either use the mobile or please just use the email initially, because it could be one or three of us.
Will I share the mobile number, John?
Yeah, pass the mobile number out. That's absolutely fine. Yeah.
Yeah. Okay. So John's mobile number here is 07834 230 455. That's 07834 230 455. Well, John, we're 8 minutes past the hour.
Sorry about that.
I'm going to be in trouble for letting you run. I just want to thank you, John, first of all. I want to thank you, first of all, so the mobile number is there in the chat box, 07834 230 455. So I just want to thank you, first of all, John, for a very informative session. I know I've taken notes and learned some things. Your insights, John, are remarkably practical, but you know, it doesn't always work that way in the real world. And it's a while since I've been an accountant, but the stuff that you're saying is just, it's so practical, so common sense, but yet I think it's something that's often overlooked. So I want to thank you for your time. I want to thank everybody who's attended live, whether you're here with us on Zoom, whether you're with us on LinkedIn, on Facebook, in the Facebook group, wherever you're watching YouTube, to thank you all for your attendance. If you join here live with us on Zoom, you can get verified CPD credits for that. And if any of your colleagues want to join our list here and become part of the free CPD offering that we're running at the moment, please do invite them. Jonathan, perhaps you could put up a link as to where people can register or where people can go to share. Thank you very much, everybody. John, thank you. Mike,
thank you, Des.
The team. Everybody, stay safe. We're in this together. We're still working our way through COVID, but hopefully things are looking a bit better than they were a few months ago. So stay safe, everybody, and see you all again soon.